Welcome to this episode number 98 of your next trade code. Today, tariffs crash. So what a week, I should say. What about a couple of weeks that we had on Thursday, on Friday, where across asset classes, the market crashed. So let's start with the chart of the S&P futures, where just after the close on Wednesday, Trump announced the tariffs, and the first reaction of the market, this one, was okay, it's fine because it's going to be only 10%. Then slowly but surely, he showed those dashboards explaining that actually, China will be paying 35% more, Europe will be paying 20% more. So all the countries more or less will be paying much more. And guess what? The market started to sell off. And as you can see, you didn't have that much volumes in between. And then we open on Thursday, a bit of sell-off, should I say, 4-5%. And when I say a bit of sell-off, that is because of a couple of days. In 48 hours, we went from 57.50 on the S&P to 5100. So roughly 12% or plus over a couple of days. So quite an amazing move, but as you can see after on Friday, that was a very ordered sell-off with the volumes, not way above what we have on Thursday. So what happened is first reaction, you sell big time first, and then, you put a VWAP order, you sell, and the market is more or less saying, okay, we go into recession. So what we have been discussing most recently is the odds of a recession were increasing. When we have a sell-off of 10% or, a drawdown of 10% from the highs, this is the normal drawdown. This is something that we saw in August last year and something that we're going to experience every 18 months. But when the market thinks that we are going into recession, that means you are coming into the 30, 40, 50% drawdowns. And now, as we have been coming down by 15 to 20% for most equity markets, that means that you're going to see the headlines of the JP Morgan and some others saying, oh, we're going to go into a recession. But, what we flagged in January, and this is something that we discussed in details in our 2025 outlook when we did the webinar, is the market was pricing for perfection. So when you start the year and you get market participants, JP Morgan, Goldman Sachs, saying earnings growth are going to be between 10 to 15%, and you're going to be paying a PE of 24 times, that should translate into 6,500. You don't have any room for disappointment. And, it could be tariffs, could be anything. Obviously, tariffs are pretty big if you think about macro. But that means now the market is still trading at 19, 20 times. So you still get a lot of room for the market to go lower, both in terms of the earnings compression, meaning instead of paying 22, you're going to be paying 16, 17 times. And as well, if you get a recession, guess what? Your earnings are going to come down. So that means you're not going to have $270, $280 EPS per share for the S&P, but you're probably going to have 240, 250. And if you pay 240 times 18, guess what? You're going to be below 5,000 on the S&P. So this is what we're going to discuss. Stay with us because at the end of this video, you're going to be offered some discount on the 4x4 video series. So year-to-date asset performance, what we have now is the Nasdaq is down 20% almost, S&P is 13%. What has been interesting is obviously this is not only for the US. All the assets and all the stocks have been under pressure this year. So we went from double digit in Europe for being down on the year. We got Japan down 15% because, as you see here, the US dollar has been pretty weak. So one of the targets of the Trump administration was to be weakening the dollar. Job is done. I don't think this is enough to justify all of it, but the dollar is down 5% on the year. If we go very quickly into the week today, this is the big picture. Okay, so you don't see that very often, that kind of sell-off. We are talking 10% over 5 days, but literally we are talking 10% over 2 days on Thursday and Friday. S&P 9%, Nasdaq. So, they all look the same. So what does it tell you when, you go from Europe to the US at 10%? So this is a risk off. People are just, reducing their exposure, reducing their longs. It's not like they think and they make a difference between, what is this share versus another one. They sell everything. Dollar weakening on the week. We had some poor liquidity on Thursday, on Friday, so big move on the euro dollar. But the most important one was the Aussie US dollar versus Australian dollar versus the US dollar. So really a big sell-off for the week on Thursday, and more importantly on Friday, where the Aussie dollar was down more than 4.5%. So really big move. Bitcoin at last is doing the job, flattish on the week, and the same with actually commodities, pretty weak. We are talking WTI, as we're going to see for technical analysis, down more than 10%, copper down 14%. Just gold was kind of flattish for the week. Friday was a bit of a risk off, as we're going to be seeing later. So I want to jump into the week-to-date industry performance, because this is the overall picture. The only one standing are the TLTs, will be the bonds. So bonds, the yields have been under pressure. The bonds have been beat because obviously this is your flight to safety, if there is any safety. And as the other end of the spectrum, actually very interesting to see oil services down 20%, energy, semiconductors, airlines. So everything that is cyclical, everything that was beat up. And actually, if you want oil to go much lower, that means it's going to destroy your oil sector energy. So you had names like Apache on Friday around the $15. So a lot of pressure into that space. I always look at energy when it is under pressure. I think it is too early though, and we need more sell-off on that space. So sectors performance, and I'm interested into the week to date. This is really the sell-off. This is the week off. You see energy, but what is interesting as well is you do have like a bit of outperformance, obviously, of the defensive sectors like utilities, consumer staples. So consumer staples did very well on Thursday when the market was off. It was up on the day, but other than that, financials pretty destroyed. And we should be flagging that on Friday we have the start of the earnings season. So as always, it's going to be JP Morgan starting the show. And the banks and the regional banks really have been under massive pressure. I don't know if we can go back here and see the regional banks. Yes, this is the regional banks. As you can see, we are talking double digit for the week. So really across industries, across assets. What about the rates? So rates now, we get the US 10 years at 4%. So when you do have like this risk off, that is normal for the yields to be coming down and bonds to be bid. Trump administration wanted the US 10 years to go down. Oh, woo-ha-ha, this is superb. It is coming down. Is it going to be enough? By far not. It's just this is a normal reaction. I'm interested into what are the Fed funds expectations telling us, meaning what is the Fed is priced to be doing for 2025. And now we are expecting 5 cuts, roughly 1%, 96 bips for the year. We were not so long ago at 2 cuts, and the Fed, 3 or 4 weeks ago was saying there is no hurry, there is still inflation in the system, we need to be careful and mindful. And actually on Friday, just on the European close, Powell said, the chairman of the Fed was saying, we are still looking at hard data. Hard data looks pretty good. Guess what? If you look at the NFPs, which are data that were past data, it is pretty clear that those data are telling you that everything is fine. The forward-looking data like the ISM manufacturing and services are telling you something different. And most importantly, clearly the market and most asset classes are telling you that the odds of a recession are now above 50%. So now if you look at the VIX, 45% at the close on Friday. So I'm always smiling when I saw people on Thursday saying, oh, the VIX is at 28, 29%, and you should be buying the S&P at 4,400. There is nothing like buying the VIX when you go, selling VIX and buying puts on the VIX when this is Armageddon. You don't know where it stopped. So most of the time it's going to be coming from, sales traders, like, some gurus that are telling you that this is the time to buy, because if you look at the last 20 times, the VIX was above 35 or whatever. Look, I've been through 2000, 2007, through COVID. You know, when that happens, you don't know where it stops. So you rather be pretty agile and trading the volatility than getting stuck on something like the VIX and getting absolutely hammered. So volatility 45%, as you can see in the chart. We are back into the 2020 levels. That translates obviously into massive intraday moves and pricing, as we're going to see later, of the weekly moves. So let's look at the technical analysis, and we're going to be doing, as always, some bit of dodgy technical analysis, but this is for the S&P futures. We have been saying that the trend was broken. We consolidated a bit below, and now we have this big move. So when you look at that chart, and I know that most retail traders will be starting with chart. You know, does it look like a long to you? I mean, clearly, if we are at the start of a selling phase and we are going into recession, you can argue that, you know, the 4,500, the 4,000 are clearly targets. This is the same for the Nasdaq. Nasdaq is telling you, I mean, obviously the charts will be very similar. A couple of days of big sell-off. And you can see the trend. We flagged that trend. If you look at the last 2, 3, 4 sessions of the Euronext trade, this is something that we've been saying. Last week we saw and we said that there were no leaders in this market, meaning that there were good chances that the market will go lower. So this is for the Nasdaq. Now we want to move into another asset class, looking at CL1. So we were flagging for month and month the 66, 67 level, and guess what? We are going lower now. So this is a break lower in actually good volume. So as always, you want to be looking at the price move with the volume. Some other stuff. Gold. So gold so far obviously has been doing very well, but as you can see on Friday, so everything on Friday sold off. So that was a margin call. Most retail traders, we talked over and over since January how retail traders have been buying the dips in February and March. And now when your book portfolio is under pressure, you need to be selling some winners. And this is what happened on Friday, where gold as well came down. A big move. This is the Aussie dollar. This is Australian dollar versus the US dollar. And you can see here massive move. So this is not only for stocks. This is across asset classes. FX, big pressure here on the Australian dollar. Finally, which one do I wanted to flag yet? So that was for Europe, because I told you over the last month or so that we had some short position in Europe. I was short actually some Spanish banks. I did okay. I could have done like a killer, literally a killer. I bought some Spanish banks back on Friday after the open, and then all those stocks went down 5 to 6%. So still making money, but you know, it's always frustrating. When you are a trader, you play the odds, or you play some outlier, but we went into like a crazy outlier. And as you can see, this is a very similar chart in terms of moves, like the S&P, like the Nasdaq, we are talking 10%. So if you've been long the market, and you know, as retail traders, that 95% of retail traders will be long the market, meaning that most of them, the vast majority, 95% of them, will be down probably 10 to 15% over the last couple of days. So going forward, you know, what we are interested is to see, you know, what's going to be happening starting this week. So this is the same chart starting with the S&P futures over the last 5 sessions. You see the bump here done in big volume over the last 3 sessions. So this is a volume profile trying to understanding where has been the big volume. So we had as well some big volume at the close on Thursday, but then on Friday everything looks pretty much the same. If you look at the different levels where the market traded between, let's say, 50 to 80 and 51.20 on the S&P future, it was just like a normal sell-off. That is the opposite at where when we squeezed on the way up. So no panic. I mean, despite the volatility at 45% for the VIX, there was no like crazy volatility, which tells me Yes, we can have a bounce. Yes, we can have, some rallies. But overall, structurally, the market think that this is so big that they are just selling their position. So we did. So this is before and after 2nd of April. So this is at 4 p.m. This is Trump saying, the world is changing. We're going to have tariffs. And if you don't sit with us, then you're going to be paying 35%. Good or bad, this is for you to decide. But, if you believe that actually the market is looking forward mechanic, and actually that most of the time when you get a stock coming down, that means, something is coming. When you believe that if the stock market is coming down, that recession, something bad is happening, you don't have to stand behind Trump or the Democrats to say that here the market is pricing recession, is pricing something bad happening. In the long run, I'm not smart enough to tell you what's going to be happening, but as a trader, I only care, about what is happening now in the next 3 months, how I can be making money, and the market is pricing that. So what about ISM manufacturing and services? Because we had a bit of macro as the start of the month, and we had the NFPs. So NFPs on Friday were better. Again, this is about looking at the past. I don't really care what is happening now. Is most indicators are telling us that the job market will be under pressure. Manufacturing through the ISM is still below 50%, meaning recession, and services has been coming down quite a lot. So odds of a recession based on those leading indicators are on the way up. So overall, a carnage, as we see here, this is the Australian dollar versus the US dollar. And as you can see, on Friday, this is your more than 4% move. So this is something that we haven't seen since 2020. 2008, sorry. So actually the move was even bigger than 2020 for the FX. So that tells you that really the market is pricing something totally different, that there were still a lot of gross exposure, net exposure into the market. I don't think this is a one-off. I don't think, market will be are still already bottoming. Similar here, we have a decent move for CL1. This is a move that we haven't seen since 2022. You can do the same for any asset, so it's a bit boring, but that tells you how big the carnage has been on Thursday and Friday. So what about the catalyst now? So let's pretend a bit like we do a bit of macro right now, because at the end of the day, it's all about tariffs. So we do have like the NFIB, the small businesses on Tuesday. More importantly, we get the CPI and the PPI Thursday and Friday. So we're going to be checking if inflation is on the way up again, and that will translate into the Fed and the FOMC saying, oh, we can't be doing much because there is inflation. We do have like those Fed speakers every single day. We have some bond supply as well. So to me, the next three big drivers. Obviously, we do have the tariff talks. Okay, so every single day we are waiting and glued to our screen thinking, okay, what Trump is going to be saying, what government, what country is going to be saying, like we had on Friday with Vietnam saying, we're going to be putting all the tariffs down, and suddenly you get Nike, Lululemon, Adidas, all the names that are outsourcing in Asia that have been outperforming and up 4-5%. Okay, so this is the one-off. You're going to be dependent. You do know that when you're going to have 4 years of Trump, this is what's going to be happening. This is all about Twitter and social media. So this is the driver number one. The driver number two to me is if you start to really believe and think that there is a recession coming. I've been flagging that 2 or 3 weeks ago. I've been looking at spreads, credit spreads at high yield. I'm long put spreads. I'm long put on HYG. Why? Because I think when you have a recession, by definition, credit will be affected. And so far, credit has been holding very, very well. I'm talking credit spreads. So to me, this is the second really big catalyst after Trump. And what is he saying? This is how the credit market will be doing going forward. We are starting to see some pressure on the high tracks in Europe, but that makes complete sense because, the spreads are widening. Market makers will be putting like larger bid offer. So this is normal, and as well you have pressure around your portfolio. So you have to be selling some of your exposure in credit as well. Third one is obviously the earnings season. So earnings season starting on Friday with, as always, JP Morgan. So here I give you the example. What I try to flag here is how the stock has been moving most recently. So sorry, we are missing a column here. But normally what you will see is JP Morgan on average is moving over the last 10, 12 earnings by 3 to 3.5%. And right now the market is pricing a move of 7%. So due to the beta and the overall market moving like hell, you have the stocks as well that will be expected to be moving much more on the earnings date. So if you take the example of JP Morgan, instead of moving by 3.5%, is roughly expecting to move by 7%, so twice as more. And this is the same here if you look at the S&P weekly straddle, which is, buying a call and a put for the close on Friday. What we are expecting is the market to move by plus minus 5.8%. So roughly 6% times, 5,000. So that's roughly a 250 to 300 points move for the week. So not so long ago, we were at 1.5, 2%, even 1.3%. So not only obviously the realized volatility, but the implied volatility has been on the rise. So to me, there are three big drivers. The tariffs, obviously, this is the one. How we're going to be pricing recession or no recession, and now we should be really looking at the credit market and the spreads. And finally, one of the obvious catalysts that we have every 3 months for the equity market, this is the earnings season. I think there's going to be a lot of, Q1 was kind of okay, but now we don't know what's going to be happening next for Q2 and Q3. And actually, if you've been a company that has been exporting or importing, you're going to be impacted a lot. And that's true for 60% plus of the S&P 500 companies. Less for the Russell 2000 companies, but actually, if you look at the Russell of the small and mid caps in the US, they really underperform the overall market. So it's not even like, Trump tariff is good for the US, at least for the US stocks versus the international stocks, because this is not what has been happening. So really there's a lot of questions as well of, who's going to be buying these bonds. Here we are talking about this 58 billion, 30 billion, 22 billion. If, Trump is saying, I don't want to do business right now under those conditions, because you are changing the deal. So I understand the art of the deal, but, the art of the deal is on both ways. And if the US have been using and be financed partly with Japan investors, with Chinese investors, that means, they could in the near future asking for higher yields. So that means I'm not sure that we're going to be going much lower than 4% unless we get a big recession. And that means the art of the deal is a bit different. So this is it for the catalyst going forward. I want to go into, as Trump has been putting most prices and most tariffs up 25%, I want to do the opposite. I'm doing an Easter discount of 25%. So this is my way of doing the opposite of Trump. I do know that retail traders, the people who are watching me today, the ones that get education are probably perfectly fine making money. I've been making money this week. For the ones that literally have been following some gurus, some charlatans, some guys doing you some spreads in options, I know you're losing money. You can have access to the 4x4 video series. This is a really nice and really in-depth investment process. I give you a 25% discount until the 21st of April. So this is it for me for this week. If you get questions on the 4x4, on the mentoring, I do the mentoring. Etienne is doing the mentoring. So we have been starting a dual mentoring program where I do 6 sessions. He will be doing 6 sessions. It works really well. If you want to join the trading community, there is a free channel. There are 30 channels on beyond a paid wall, only $75 per month. So literally it will pay for any trades that you will be doing on the day. Any questions, you can send me an email at greg@duponttrading.com. So this is it for me for this week. There won't be any your next trade next week because in a couple of weeks it's Easter, and that means this is going to be a short week. And this is a family week. So other than that, questions you send me, I hope you're good. It's all about risk management these days. I know that people are making fun of me and saying, oh, Greg, is boring, risk management. I can tell you that I do have like a tons of emails these days of people coming to me and say, oh, Greg, you were right. I've been losing 20% for this high PE, this high stuff. So come to me and I'll try to answer your question. This is it for me for this week. Have a good trading week. Bye-bye.